Valens Research, Uniform Financial Analytics.
Looking at Roku, those of you who don't know, Roku is a business that they make set-top, basically streaming devices. They make various ways for people to be able to stream and the software that people use to stream. And the most powerful thing when we look at Roku, if we remember from Microsoft, what we're looking at here, these are the blue bars, are the uniform accounting adjusted returns of Roku for the last 4 years since Roku has been public. These two light blue bars are what analysts are forecasting, and these white bars are what the market's pricing in right now. And for Roku, right, what jumps out to us is this is not a company with negative ROAs, negative 2% ROAs as reported metrics reflect. This is a company with positive ROAs, positive 20%. Looked at differently, one of the things that we look at here at Valens under uniform accounting isn't just ROAs and asset growth. We also look at a company's adjusted earnings versus their as reported earnings, EPS versus our EPS prime. What we can see is on an as reported basis, Roku has a negative 10 cents of earnings. The market thinks this company is losing earnings, is losing 10 cents on every single dollar of revenue they bring in, basically. In reality, this company is throwing off 70 cents of earnings a year. This is not a negative ROA business that we're waiting to turn into a profitable business. This company has been profitable for the last 4 years. Now, importantly, what we're not saying is just because ROAs are stronger than as reported reflect, that means that Roku is a buy. Because if we look at these white bars are what the market's pricing in for Roku right now. And Roku is priced right now for ROAs that were 20% next year to basically get to 36% if we think that growth is going to be around 30%. Now, let's just do a quick scenario analysis here for Roku. Let's say that Roku has been growing really at basically 50% a year or so, 30, 100, 60, and then 50 is what it's forecast to grow for 2019. Let's actually say that we think that Roku is going to be able to see asset growth, investment in the business that continues about at roughly 50% a year going forward. If we actually think that can happen for Roku, I can use the embedded expectation tool here to actually build a scenario. Let me actually just let the embedded expectation tool load here because it's just catching. And there you go. If I type in 50% here for asset growth. Now, if Roku keeps growing at 50% a year, they need to get to an ROA that basically maintains where they were in 2018. Not unreasonable as you think about demand for streaming and streaming solutions, which they offer a platform for people to use to be able to happen. In fact, it's very possible that they could actually hit that. We don't have an opinion, to be perfectly honest, one way or another here at Valens. Our goal is to be able to help you understand, though, what is it that the market's thinking so you can figure out if you're having a divergent view. On Roku, the important thing is you couldn't even look at the as reported financials and think that you had an educated opinion, because if you looked at the as reported financials, you would think Roku was a money losing business and you would probably walk away. But at least when we look at the uniform accounting metrics, we can see in reality, Roku's a profitable company with high expectations. But we can understand what's going on there because we don't have directionally wrong data that we have using as reported accounting metrics.
Valens Research, the world's leading source for uniform financial analytics.